Welcome everyone to today's Long-Term Care Insights webinar. My name is Ed McCahill and I'm a Senior Private Wealth Advisor in the Ronald Blue Trust Seattle office. Joining me today is David Wolf, owner and president of Wolf & Associates in Spokane, Washington. David has focused solely on long-term care since 1995, 26 years ago. He's seen it evolve from an immature niche industry to an essential piece of many people's financial planning and estate planning strategies. David is a nationally recognized speaker and podcaster on elder care issues, and he is licensed in all 50 states. He is also a Thrivent strategic partner. Many of you know that Thrivent is our parent company. David has been a friend and trusted long-term care expert of our Seattle office for several years. Welcome to the webinar, David.
Thanks, Ed. Glad to be here. I hope that we can add some meaning and clarity to a topic that I think a lot of us wish we didn't have to talk about. But I also think that this particular topic has some significant ramifications for two values that Ron Blue clients hold dear: family and generosity. And I think that it's critical to both the financial and the relational legacies that we leave behind us.
That is true, David. So David and I will be having a conversation on long-term care today, supplemented by some PowerPoint slides and other questions coming from you in the audience. The conversation portion of our 60 minutes will run 35 to 40 minutes, with the remaining time dedicated to answering your questions. At any time during our conversation, please feel free to enter your brief questions into the Zoom chat window, which you can find by hovering the mouse cursor near the bottom of your Zoom screen. It'll pop up. David will answer as many questions as he can within the time we have. If you have more complex questions, or if we run out of time today and did not answer your questions, please feel free to contact David directly or reach out to your Ronald Blue Trust advisor for help. Now let's get started. David, thank you for joining us here today. Tell us what drew you to enter the long-term care market back in 1995.
Great question. And I think I'll start it this way by introducing the fact that I am second generation in this business. So I followed in my father's footsteps 26 years ago. And, it's actually interesting because my family got into this industry initially out of some experience with three aunts who had Alzheimer's all at the same time. And I had that experience along with my family. That's what sort of launched us into this industry. But at the same time, I can say that actually really didn't become real to me until I became a caregiver myself. It was when I stepped into those shoes of a caregiver that things became real. Unfortunately, this was a caregiving event for my wife. What was in theory at that point became a reality to me. And I actually experienced what others walk through when they become caregivers.
Wow. Well, speaking of caregiving, how has the care delivery system changed and evolved since the 1990s?
Yeah, great question. And I think maybe we'll launch this way. When we have a conversation about the evolution of the care delivery system, I think we should start with sort of a bold statement. We talk too much about nursing homes, right? Ultimately, this care delivery system has changed dramatically, and the way we use the word nursing home today is not reflective of what's happened in the delivery system. So let me start this way by kind of giving you a little bit of background. In 1990, the New England Journal of Medicine told us that the average length of nursing home care sat at 2.9 years. Today, it's 3 to 8 months, right? The care today is not happening in the nursing homes. That 3 to 8 months varies depending on whether it's male or female. So gender plays a big role, as do socioeconomics and rural or urban conditions. But ultimately, this duration here has shrunk significantly. And today, the care that's delivered in a nursing home is the most significant events, or it's just the rehabilitative event. So what happened? Let me give you a little background in economics here. In the 1990s, or actually in the 1980s, we capped our nursing home beds. We did so via what are called certificate of need laws, which essentially placed a moratorium on nursing home beds being added to states. And as a result, we had a stagnant supply of nursing home beds and an aging and growing population. So what did we do? We started inventing things, right? We didn't know what an assisted living facility was in 1990. Nor did you know what a memory care facility was. In fact, the insurance industry didn't even call them assisted living facilities. They called them intermediate care facilities. We didn't know what it was. So, ultimately all the care started shifting. And over time, what happened is we ended up pushing the nursing home further and further back in the care delivery system. Even 5 years ago, I used to tell people that if you need what's called a dual person transfer, you're now in a nursing home. Today, the assisted living facility says, we'll keep you. We'll just bring the home care agency in the morning to bathe and dress you. Or the residential care facility says, we'll keep you. We'll just employ hoist. This is still headed this direction. The nursing home is shrinking in terms of its position in the care delivery system, and home care is growing at an exponential pace faster than all facility care put together. So the hidden good news here is that in the future, care is most likely to happen at home, right? And ultimately, the insurance industry responded to some of these evolutions and started evolving the products and allowing us to use them in other settings. And here's how I think of the world today. Today, the world is really simple. There's only two places you will ever receive care. Your home, not your home, right? This is really simple. This is home care, facility care. So for the most part, carriers don't really care anymore where you receive care. What they care about is the provider you are hiring is licensed with the state in which you are living, right? But they don't care about where, they care about fraud. And so, the take home here really is simple. This is the most dramatic shift in the evolution of the system, and ultimately most care in the future is going to be done at home.
Oh, fantastic. So, David, I understand that the early products were not priced well, and that gave both the industry and consumers some trouble. Many carriers underpriced their insurance products and had to raise rates on them, and others have chosen not to sell the product any longer. So what might we expect in the future?
Yeah, I think a really critical question, in terms of understanding the difference between, the windshield of the future and the rearview mirror of the past. There are several things that went wrong early long-term care pricing. Now, I'm going to highlight two of these because these were really the troublemakers. They're both interest rates and what we call lapse rates, or how many people keep the product versus drop the product. So we're all familiar with the fact that interest rates in the early 2000s collapsed, right? And that challenged the ability of insurance companies to create and build reserves for future claims. The good news is that the better place to purchase an insurance product is actually when interest rates are low and have the likelihood of rising, because that will not only support that reserve building, but potentially even create a situation where there's a rate decrease via a dividend return. Right? So interest rates played a role, but ultimately the big problem child of the past was this one right here. Carriers didn't expect people to actually keep these products, or at least they didn't expect the majority of people to. So, early on, our lapse assumptions assumed that a significant portion, if not the majority of people who purchased this product, wouldn't keep it until the time when they actually needed it. And as a result, carriers ended up with sometimes 2 or more times the claims that they anticipated, simply because people kept the product. So, the good news here is that this is now a solved dynamic. This will never rear its head again, because this is a known quantity. It is a 0.6% lapse ratio. Literally 0.6% of people drop it per year. We know what that number is, which means this is now done. This is likely to improve, which took care of, or actually addresses, some of the key problems of the past. So that's just a little bit about pricing and what we might anticipate. But ultimately what it means is this. If we go back to the year 2000, we now know in retrospect that the average product on the street had about a 40% chance of rate increase. By 2007, we had dropped down to roughly 30%. By 2014, we were down to 10%. We're actually living in single-digit territory out here. So the good news is that not only is the product that is priced today less likely to have a rate increase, it's actually a much higher likelihood it's going to have a rate decrease via dividend return. So that's just a little bit about pricing, and ultimately you asked a second part of that question, which is, well, what happened to the carriers who left the industry? I'm just going to divide the industry into two simple halves: publicly held stock companies and mutual companies. Stock companies are owned by shareholders. Mutual companies are owned by policyholders. Here's another dramatic shift. The industry used to be dominated by stock companies. Today, it is dominated by mutual companies.
Hmm.
So most of the carriers that have left the industry fell into this side of the equation, right? Because they were concerned about, can they actually predict profitability on a product that might not have a claim for 25 or 30 years?
Hmm.
And how do they produce their quarterly earnings report for Wall Street? So this is the shift that happened, but the good news is those who purchased those carriers still have the product. They're still being serviced. It's just that those carriers are no longer offering new products for sale.
Great. Well, that kind of answers almost a third question, which would be what happened to those policies that people bought back in the 90s and early 2000s. And I think you answered that. They shifted over more to a mutually owned structure. So great, David. Thank you. So, well, earlier you mentioned long-term care planning. What are people typically planning for with their long-term care planning?
Yeah, so I think this is the pivotal question of the day, and it really helps us get our hands around what in the world is long-term care planning, because I think most of us tend to associate these three words with a care setting, right? This is home care, this is facility care, this is whatever it happens to be or whatever you've experienced in your life. But the simpler way to understand long-term care planning is really through one simple word. This is planning for frailty, and long-term care insurance is frailty insurance. These products all trigger because you are either physically or cognitively frail. So the magic word in the long-term care world is the word safety. If you are cognitively impaired, certainly there is a test that's going to demonstrate that. But there's also a licensed healthcare practitioner stating a safety concern. You're not safe alone. You need supervision. You're not taking your meds. You're wandering. You're leaving stuff on. You need supervision to ensure safety, right? So that's cognitive frailty. Physical frailty is an impairment in what we call our activities of daily living, or our ADLs for short. So our daily activities are things like bathing and dressing. Transferring is getting out of bed or out of chairs. Toileting, continence, and eating. Those are your 6 daily activities. So if you are physically frail, what that technically means is that there's a licensed healthcare practitioner stating that you need help with 2 of these at what is called a standby level. Somebody is standing by, right, to ensure safety. So think of these through the safety lens. And I'm going to make this world really simple once again. Those first 4 activities, bathing, dressing, transferring, toileting, they're all the same thing, right? Bathing is on a slippery surface. It's a fall risk. Dressing requires we reach our feet to put our shoes and socks on, or we stand on one leg to put our pants on. It's a fall risk. Transferring, shifting your center of gravity. Again, you're seeing the pattern here. And toileting is not about doing your duty. It's the getting on and off part, right? This is mom slipped. She fell off the toilet. She hit her head on the tub. So really, all of these activities from a safety perspective are all about one simple thing. It's about your balance. When your balance is compromised, that's what creates all of these issues. And actually, this is the order that these are lost in. So virtually every single long-term care claim I've seen in 26 years, if you need help due to physical frailty, you need help with bathing and dressing. And this person here who has this balancing challenge, I'm going to put a permanent visual in everybody's head. It's what we call a furniture walker. You don't get across the room without grabbing things, right? So this is what long-term care eligibility looks like. This is how the products turn on, how they pay benefits. And I'll, again, create some simplicity here. Every product in the industry since 1996 is 100% the same. There's no difference. So, ultimately the question becomes, what are we planning for? We're planning for frailty. And the biggest driver in frailty, actually represented by that line right there, that line's a representation of what we call the morbidity curve. That is the risk of becoming either physically or cognitively frail. So early in life, risk is low. The odds of you needing this before your 65th birthday is in single digits. In your 70s, we're in low double digits. Really it is out here where things go through the roof. This is common sense. And yet at the same time, I think it's worth pointing out because we all tend to think that our health is the most accurate prognosticator whether we're going to need this. In reality, that's not true. What is the most accurate predictor actually is your longevity. Longevity is what drives this. And ultimately, if longevity leads to frailty, here's the kicker, is that that family then has a binary experience. There's only two choices a family has. Either somebody in the family is going to become a caregiver or somebody's going to get help, right? The default is the first one. So, the challenge is that the family doesn't get help when they need it. Family gets help when they're tired, when they're exhausted. And I think this was, originally brought home to me in a very real way, and perhaps the most enlightening conversation I've ever had in my career. And it happened to occur with the person who is still today the wealthiest client I've ever had in my career. And I started a conversation with this client, and he stopped me one sentence into the conversation because I was asking silly retirement planning questions. He said, "David, I don't need you." And I was lucky enough to respond quickly and say, "Tell me why you don't need me." Then he pointed out to me the sporting franchise that he is an owner of, and quickly told me that he didn't need me because he could afford to pay for care. The only reason he was having a conversation with me is because he was going to prevent his daughters from doing what they did, right? They cared for mom in their home for 8 years, not because they couldn't afford the care, but because they were trying to prove to her they loved her. So his response was enlightening. It's still the most enlightening response I've heard to date. He was going to create an obstacle to his daughters doing what they did. So that was my moment of enlightenment. And, this common thread runs through every single conversation I've ever had. People don't plan for this just to protect money. They plan for it to protect people. And the most enlightened conversations I've had are with those who have the ability to envision that potential and envision the consequences that their having planned or not planned for this might have on their family.
That's a powerful, a powerful story right there at the end. So, David, are there any other why reasons on people's hearts and minds as they consider buying long-term care insurance?
Yeah, I think we'll sort of revisit what I just uncovered there or laid out for you. I've never had a conversation with a client that at some point during the conversation didn't include the B word, right? They brought out this word. I don't want to be a burden on those that I love, or what they're really telling me is that they wanted to protect those family members, and sometimes protecting them from their own worst instincts. So the non-financial reasons happen to be the driver most of the time, or at least are included 100% of the time. And then really the financial reasons can be boiled down into two different things. Do we protect the ability of the surviving spouse to maintain or sustain their lifestyle? So, the general rule of thumb in a couple, I don't know if you've spent time thinking about this, but usually one person's going to live longer than the other, right? And we have to make sure that whatever's left for that other person is, substantial enough to maintain their standard of living. And then the other driver is this one here. It's all about legacy planning, and I'll divide legacy planning into two different motivations. One being financial legacy, and the other being relational legacy. I'll explain what I mean by that here in a moment. So, from a financial perspective, the baby boomers fall into a really predictable bell curve. 80% of baby boomers are what we call the if there's something left clients. Typically, boomers aren't all really motivated to leave legacy behind them. Now, I suspect that's not true in most of the clientele of Veran Blue Trust. And so ultimately, the question becomes, do we intend to leave something beyond us to either those we care about or the causes we care about? But I will tell you the other driver, and this is true of every financial or every long-term care planning event that we've ever engaged in, and that is that, families are motivated to leave a relational legacy. Not only do they not want to be a burden, they want to create a circumstance where their family grows, thrives, and has the margin to give generously to those that they love. Not just financially, but in terms of their time. So I think those are the two drivers.
Wow. Okay, well, as wealth advisors, some of our clients ask us if they should consider buying long-term care insurance or self-funding those potential future expenses? I usually respond that it's a personal decision driven by many factors, some of which you already covered, but uh, can you just share with our listeners some of the main reasons why your clients purchase long-term care insurance and also why others decline to purchase it?
Yeah, great question. Let's talk a little bit about self-insuring. So, I think the more accurate way to think about this is that why people choose to engage, and I'll just call it planning versus purchasing. Why people choose to engage in some sort of planning for this really has relatively little to do with wealth level or their ability to self-fund. It has a whole lot more to do with their perception of risk, right? Those who perceive risk, who can envision this in their future, that they might live long enough to become frail, see insurance as compelling, efficient, predictable. And those who perceive very little risk or believe that they may never need this, really they see the premium as intolerable. Those are the two categories. So, the challenge in this conversation is, as advisors, we are engaging our clients in a conversation. And the reality is all of our clients see life through a set of these, right? They see life through a set of lenses. And each of our set of lenses are our own experiences. Our experiences are way more predictive of what we might do or how we might behave than any logic that we can present. So, kind of with that thought in mind, let's take just a quick look at cost of care. Let me give you a sense for what this might look like either presently. So you can see home care and assisted living. By the way, we are using some different inflation assumptions for home care and facility care based off of historical averages. But if I project that out in the future, out 20 or 30 years, you can see perhaps what some of those costs might look like. If we do the same thing at a 5-year care period, here's what we need to sort of engage in or wrap our heads around. If we need to use care in the future or we become frail, what do we need to either set aside? And by the way, if you intend to be a self-insurer and fund all these risks, my advice to you is set it aside now, right? Put it into a fund and write out a set of instructions for your family to actually use that, because their natural inclination is not to do so. So give you a little feel for, total cost of care, both present and in the future. And then, ultimately, I skipped forward too far there. Ultimately, the challenge becomes, how do we sort of right size these products? The goal of planning for this isn't necessarily to be at either end of the spectrum, right? We're not necessarily trying to either fully insure this or fully self-insure this. Usually what we're trying to do is find that happy medium ground where, maybe we've engaged enough insurance to mitigate this risk versus eliminate it. And we've also pushed the family the direction we want them to go, which is all about, encouraging them to get the help they need when they need it and not when they're worn out. I hope that's helpful.
Very helpful. So, David, let's move now into a series of questions that I think some people in our audience may be wondering about. So I've got a list of several here. So the first one, at what age should people consider buying long-term care insurance?
Yeah, great question. So I'm going to answer that question with two answers. And one is the what should people do, and the other is what do people do? That's the difference between logic and behavior, right? Well, we all tend to think we're logical creatures. The reality is we're not. We're emotional creatures. We back up our decisions with our logic. So ultimately, the average age of purchase in this industry sits at about 57, technically 57.2. And, is that what people should do? There's lots of people who give advice in this industry. Some say we should do this closer to 60. Some argue for earlier. The reality is you can always make an argument for earlier based off the fact that the cumulative premiums you pay in your life will be lower. That being said, early in life, in our 30s and 40s, we have other planning priorities that are much more important than this one, right? So, younger is better. At the same time, the real answer, why do people do this in their late 50s, is because if you add 25 to 30 years onto that, how old are mom and dad? Right? We're behavioral creatures. We don't do things that we should do. We do things that we are compelled to do because something is disturbing us. And so when we see that generation above us starting to get frail, that's when we take action.
Right. So, well, if people wait to buy it, is there an age at which it's no longer available to purchase?
Yeah, another sort of dramatic shift in this industry. It used to be that we could buy these products into your mid 80s. Some carriers, or all carriers now, will not offer past age 79. Some carriers out past age 69. So, the age at which people do purchase is a fairly tight bell curve. 90% of people buy this between the ages of 50 and 70, and the tighter bell curve than that is 55 to 65.
Okay. Well, thank you. So, which pre-existing conditions will disqualify a person from purchasing long-term care insurance?
Yeah. So this what you're asking is really about insurability and underwriting. How do carriers do their underwriting to assess whether or not you can get a product and at what price? Right. So think of underwriting in these terms. There are a certain number of conditions that you cannot get long-term care insurance. These fall into some pretty broad categories. The neurological ones, you've had multiple strokes, you've been diagnosed with MS or Parkinson's, you use assisted devices, you have memory challenges. Those are the obvious ones. But think of underwriting more like this. It kind of works like a point system. You get a certain number of points for each condition. Right? And sometimes those points are additive, 2 + 2 = 4. Sometimes those points are multiplicative, 4 × 4 is 16. So those are what we call in our industry comorbidities. One condition is related to another condition. But the simplest way to think about it is you just add up points. And at some point, the premium goes up, and at some point, we run out of options.
Well, along the lines of underwriters, what exactly are they looking for at the underwriters when they're reviewing a candidate's application?
Yeah, so let me make this as simple and clear as we can. In real estate, we have the old adage, location, 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 right? That's what matters. In long-term care, it is stability, 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 right? Well, what we are making an argument for when we are attempting to insure somebody or making an argument for their insurability is simply that we have a stable condition. And so, what causes more challenge than uninsurable conditions is the proximity of a recent event. You just had a hip replacement, right? And we just need a stability period before we apply, or we need to make an argument for why we should apply before the carrier stability period because of your activity level.
Wow. Okay. Well, let's shift for a moment and discuss the mechanics of how long-term care benefits work. So when and how can a policyholder access their benefits?
Yeah. So I'm going to go back to a slide that we had talked about before. Actually, it's not in my order here. So let's just talk about it this way. You remember the slide we talked about where we talked about frailty, right? This is the access point. If you are either physically or cognitively frail, and there is a licensed healthcare practitioner demonstrating that in a written plan of care, that's what allows you to turn this product on. That is the light switch that allows the product to pay benefits.
Okay. That sounds about right. So I assume you go to a doctor and the doctor will qualify you. Is that right?
Let me just say this. Your doctor often is thought of as the person who triggers these products. I will tell you that most of the time, your doctor is not the good person to do this, right? Because your doctor is more interested in the hypertensive med you're taking than whether or not you can get to your feet to tie your shoes. So ultimately, usually the person who is building this plan of care is either the nurse who works for the home care agency or works for the assisted living facility. So, you can design what's called a written plan of care with those individuals. Or you can choose, if you want to hire your own advocate. We have a group of geriatric care managers who build these plans of care all day long for clients, and they work directly for that client to do so. And so that is how the product starts paying benefits, is we have to have that written plan of care. And that plan of care should demonstrate not only the loss, but the full scope of that loss.
Got it. That makes sense. So David, how long do the benefits last?
Yeah, so we're going to talk about the mechanics of a product and how these work. One of the dynamics that you're talking about is this one here. this product is going to pay for a certain number of years, or at least that's the way it is explained from a consumer simplicity standpoint. How many years of care does the product pay for? These can be either individual years or they can be shared years. So just to elaborate a little bit further on that, there's also a daily benefit. How much does the product pay per day of care? This is either, you're paying some and the insurance company is paying some. That's the cost sharing mechanism. The product design also includes an inflation guard. How much is the product going to inflate so that actually means something 25 or 30 years from now? So those are the big drivers of premium. So think of it sort of like an a la carte menu. You design your own. It's kind of like car shopping, right? You go out and you design your own car, but usually your ideal car isn't your ideal price. And so we have to find some place where those things marry up.
Got it. Okay. I see on the right-hand side of the screen as well, David, the elimination period and the home care percentage. Can you just touch on that for a moment?
Yeah, so the elimination period is the number of days of care that you have to either pay for out of your own pocket or that you don't receive benefits. The more accurate way to understand is that you don't receive benefits. So, the early products in this industry required that you were paying for care during those days. And they were what we call service day elimination periods. You had to actually pay for care. Today's products are calendar day elimination periods. Just a number of days have to go by, right? So, I'll just say it simply like this. This is where most people buy. This is the vast majority of premium because this is all about just economics of, what is the best purchasing point. If I design a 30-day elimination period, you might pay 20 to 30% more in cost than a 90-day. So virtually everybody does a 90-day elimination period because, you're much more, it is much more beneficial for you to spend that extra 20 to 30% over here on something catastrophic than on something non-catastrophic like a number of days up front. It is also true that those elimination periods are once in a lifetime. Medicare days, if they are received, do count. Ultimately, most of these products, 87% of claims start at home. If you receive any service in any week, all 7 days count towards that elimination period. So most of our clients don't spend a lot during that time frame.
Wow. Okay. And then the home care percentage piece?
Yeah. So home care percentage, this is, kind of a throwback to the past. Early products paid partial home care benefits, and there are still products in the industry today where you can reduce the home health care benefit. This, again, is a no-brainer. Everybody should buy 100% home health care benefit. Why? Because if we go design something with a limited home health care benefit, meaning it is a percentage of the daily benefit, ultimately you might save 15% in premium, right? But the other thing you should know is that home care is the delivery system of the future. The vast majority of claims are going to be filed at home. So, if we design something limited there to save a few dollars, we're going to end up regretting that later on.
Yeah. Well, that's a good segue into my next question, which is if you, once you choose your amount, your pool of funds, can you add to it after the fact?
Yeah. I mean, this is a frequent question. And the answer, unfortunately, is that no, you can't. You actually, once you design a product, the only way you can add to it is to reapply for another product, right? So we want to design these products and integrate them to your financial and estate and legacy goals up front. In the future, you can always reduce the design of the product. You can go down to any one of these elements, but you can't go up.
Got it. Okay. And how about if a couple, I noticed on your slide here, you have shared at the lower left. If a couple buys a product, do they buy it individually or can they buy it as a couple and share the benefits?
Yeah, you can buy it either way. So, I can say, well, let's take a 3-year product and one person has 3 years and the other person has 3 years. Those can be entirely separate, or we can pay for a rider that we call a shared care rider. And that rider actually gives you ownership rights over your spouse's policy. So one person has 3 years, the other has 3 years. Now we've got 6 years to share. So if the first person runs out of benefits, they can tap into the other individual's policy. If the first person passes without using all their benefits, I mean, in extreme example, they need none. We leave all 6 years to the surviving spouse. Or if we need 1 year here, we've got 5 years remaining over here.
Wow, that's awesome.
So it's actually a fairly efficient way to design something, not knowing who's going to need this and for how long.
Right. Well, that seems like an innovation to me, and a very good one. So now, David, what other kind of innovations have you seen in long-term care over the years?
Yeah, so I mean, I think really, the innovation in the most recent history has been along the lines of product chassis. You can't read about long-term care on the internet without incurring, discussion about past rate increases, which I think we've addressed already and talked about why that is less likely in the future. But the other one is this one, the advent of what we call hybrid products. These are life insurance products that can also pay for long-term care. And there's really two versions of these products. One is a life insurance product that has what we call an accelerated death benefit on it. It can pay out early in the event that you need long-term care, right? But the life insurance death benefit and the long-term care benefit are one and the same. All the carrier's doing really is adjusting their mortality table for an early payout. So, this is more life insurance than it is long-term care insurance. Generally, we would advise clients not to buy that product as a primary long-term care planning vehicle. It's a better sort of afterthought vehicle if you have a life insurance need. The other hybrid product is what we call a combo product. This is a product where the attempt is to minimize the death benefit and maximize the long-term care benefit. The goal here is to, push more of the dollars towards long-term care and less towards life insurance. The life insurance is really there just to give your money back if you don't need it. So, obviously that creates a vehicle that creates more long-term care benefit than the previous and less life insurance benefit than the previous. Technically, you can actually do the same thing over here with a pure long-term care vehicle. We can design a long-term care vehicle and we can stack life insurance on top of it too. We just call it something different. We call it a return of premium rider, right? And so ultimately the question becomes, how do you want your dollars used? Is there some advantage to getting your money back if you don't need it via a death benefit? Although I will enlighten all of us this way. The only way you don't know that you need, or you didn't need this, you're not here anymore. Right? Well, which ultimately means that this life insurance benefit, we have to analyze the efficiencies of it. Is it more efficient than you just going out and buying life insurance? Mm-hmm. Yeah. So a lot of discussion on that front, a lot of articles about those products. I think this really just boils down to, well, what's the most efficient way to accomplish the goals that you have, and which product lines up with it versus which has the best marketing spin.
Got it. So, well, we're coming up on the 40-minute mark, so I'm going to speed a little ahead and skip a slide or two here. But David, I'm touched by the fact that your client that owns a sports franchise that obviously has significant wealth, and they are trying to basically give their daughters the freedom and the encouragement to take advantage of long-term care options when they become frail. So how difficult is it, in your experience, for adult children to follow their parents' wishes in this area?
Again, I'll just make the statement that the rule of thumb in my world is that family doesn't get help when they initially need it, right? The rule of thumb is that family becomes a caregiver first. When they're tired, they start to get help. And ultimately, the challenge there is that if you've ever been in a support group for caregivers, one of the rules of thumb for a caregiver is everybody experiences burnout. At some point, we get exhausted, and now we're looking for help. And so it is really challenging to get our family to actually follow our wishes. So, to some extent, we're almost better off to write out a plan. Few of us are that proactive, but we do it with our wills, right? So give your family instructions. If this happens, if I become frail, well, what choices would I prefer you make?
And David, is there a format for that? A long-term care planning meeting?
Yeah, I mean, I think there's not really a written format for developing a plan of care or a legal document to inform your family. I think this is just simple, a statement of intent. These are funds or insurance that I want you to use, and The reason I did this planning is so that you didn't have to take on this full challenge.
Right. Okay. It sounds like one of the things we could integrate in a Ronald Blue Trust family meeting, which we do have with many of our clients to help them pass on their wisdom and their wealth and their principles and values to their children and sometimes grandchildren as well. So, well, David, as we wrap up the conversation portion here and move over to questions and answers, thank you for sharing from your wealth of expertise. It's been very, very insightful. Clearly, the long-term care insurance decision really includes a series of financial, emotional, and philosophical considerations, and you've done a really great job covering those. So I want to remind our audience that they can enter brief questions into the Zoom chat window at the bottom of your screen, and David will work his way through the chat window questions now.
Yeah, so I see a couple of questions here. I see a question about, is it too expensive to buy insurance if I'm already in my 60s? I think I'll reiterate my previous discussion about sort of the bell curve of when people plan. You know, the bell curve is between 50 and 70. And ultimately, no, in your 60s is right in that sweet spot of the bell curve. And so, you know, would we have been better off to plan your 50s? Sure, but ultimately, we're still in that sweet spot for planning. There's another question here about does long-term care coverage cover cognitive decline, not just based on ADLs? And I think that was the first point of discussion we had, was that you don't have to have both. It is one or the other. So when we file a claim, we're demonstrating via a written plan of care by a licensed healthcare practitioner that there is either one or the other. There's a safety concern due to cognition, or there's a safety concern due to, you know, what ultimately ends up being a balancing challenge, an impairment in your ability to perform your daily activities.
Okay.
There's another question here about, please revisit the slide on home care, assisted living, and elder home cost over the next 30 years. So it sounds like somebody wants to take some notes here and jot down some of those answers. So I'll just throw that back up on the screen while we tackle the next one. This is the 5-year slide. There's obviously a 1-year slide as well. The elimination period was, I think we addressed that, Ed, in your question. This is simply, think of it as a deductible in days instead of dollars. So instead of you having to fund a certain number of dollars, like your homeowners and your auto insurance, there's a certain number of days for which the product won't pay for care at the beginning of the very first care event. Okay, again, those elimination periods, if the days are met by Medicare, that counts in all contracts. If you receive care during that elimination period and you only receive, you know, a service in a week, virtually every contract in this industry will say that all 7 days count. So we need your support system to assist you during that first elimination period. What does the average long-term care product cost? We're getting a question here that now we're getting into the weeds of, you know, this individual is asking the question, what does a car cost, right? Depends what features you add, right? There's cars you can buy that get across town, and there's cars that are a lot more comfortable. So it just depends on what you do and how you put together the basic mechanics of duration, daily benefit, and inflation. It also depends on your age. So actually, maybe we'll elaborate there just a bit. You know, your age is a factor in the cost, as is your gender. So this is good news, men, bad news, women. Women use more long-term care than men. Why? Because women live 4 years longer. Women actually use 70% more long-term care benefits than men. So the pricing in these products is the exact opposite of life insurance. And life insurance, men are expensive because we die earlier. And long-term care insurance, men are cheap because we die earlier. Right? So those two elements play in, and actually the health can swing the premium almost 200%. So we have to, you know, really nail this one to make sure we have any integrity in our pricing. And part of the challenge in this industry is, you know, you call up and you ask for a quote on long-term care pricing, and usually that quote is built without any knowledge of your underlying health conditions. And so you may be comparing apples and oranges and bananas versus something that's accurately priced for you. Great question.
Okay. Still coming in here, David.
Have you had success with applicants who are initially designed for or denied for long-term care and then reapply later? I'm going to answer that broadly, and I'll sort of revisit my discussion about stability, right? The more common reason that people are declined, it isn't because they have an uninsurable condition. It's because they applied too soon to a condition that recently happened. And so, if you apply for long-term care, part of the challenge of this industry is you make an application for this insurance, and that application is going to go before a person, an underwriter, and they're going to make a decision. And usually underwriters make fairly conservative decisions, right? They're interested in protecting their job and not making bad decisions. I kind of view this as my job. Think of me like the attorney. I am arguing for your insurability, right? So how we position this is everything, and the picture we paint is everything. So the answer to the question, I think, directly is yes, we've had a lot of success applying for coverage for people who have been previously declined. We just have to define the reasons why, and is that an obstacle we can get beyond?
Great.
And the other question was, why is the 20-year cost for assisted living higher than the home care? That's because of the inflation assumptions that we used here. Great question. Very insightful. Notice we used a 3% inflation on the home care and a 5% inflation on the facility care. That's historically what's about happened in the last 50 years, right? Facility-based care is inflated a lot lower or a lot faster than home care. Why? Because facility care is a lot more complicated. In home care, it's just pure labor. We're not building buildings and hanging chandeliers and putting in fancy carpet, right? And so as labor costs have not risen in pace with other healthcare costs, we've gained more and more purchasing power at home. So we are making an assumption that past historical inflationary trends will reflect, future historical inflationary trends will reflect past ones. And that is an assumption, but great observation.
Okay. I think we might have missed a couple of the questions as you've gone by. They've been coming in.
Yeah, go ahead and call them out as you see them.
Okay. I think there's a question about, do benefits drop if you become eligible for Medicaid?
Yeah. So if you become eligible for Medicaid, do benefits drop? No, there's no relationship between a product you own and whether you qualify for Medicaid, in the sense that the product's going to pay out because you own the product, right? Whether or not you qualify for Medicaid. And the reality is that, I've almost never seen that occurrence, but I suppose it is possible. There's a whole host of other questions that we may not have time for today in terms of the relationship between Medicaid and insurance. Those sort of revolve around what we call partnership programs, where states reward you for having made purchases of long-term care insurance. And I slipped past it. I didn't know if I had it in my slide deck. So, ultimately, if you own long-term care insurance, the states will reward you in a dollar for dollar match basis. If you use insurance first, they'll raise your impoverishment level. So if you use the insurance first and the insurance paid out $1 million, they're going to raise your impoverishment level by $1 million. So that's something we can explore on a one-on-one basis in individual planning circumstances, but great question.
Okay.
So question here about what insurers do you recommend? The funny part is, this actually gets back to my commentary about stock companies and mutual companies. For the most part, the stock companies are no longer selling the products. The mutual companies are. So there's a limited suite of products that are available by a pretty tight market. In the what we call pure long-term care products, there are quite a few carriers, but less than 10. And in the combo or hybrid products, there's less than half a dozen carriers there as well. And so, we expect and anticipate that that'll change over time, but it's not like we're comparing hundreds of carriers.
Great. And did you cover the question right above that one?
Yeah,
Oh,
we
no,
talked
sorry,
about
right below
that
that one. I'm
in
sorry.
reference
Right below
to the
that one.
cost of care and inflationary trends.
No, the one below it. I'm sorry.
The one below it asked, what does a typical home care cost if it's 24 hours? Well, that's all just adding up hours, right? Care is cost by the hour. And so, national average in most areas of the country, you're spending somewhere between $20 and $30 an hour for home care. There are some areas of the country that are higher than that, and you're just paying by the hour. A lot of times, if our clients really want 24-hour home care, they're going to hire live-in providers. They're going to hire independent providers who don't charge by the hour. They charge more by the day because, the honest truth is with home care, if you're receiving 24-hour care, there's a whole lot of care hours during the day that are not a lot. There's not a lot going on, right? And so you're going to get a better rate by not hiring an agency if you need a true 24-hour shift. Although I will tell you, in a 24-hour care setting, the economics tend to drive towards facilities. Once you get to about 8 to 10 hours of care per day, what it really means is you need 24-hour care and the family is getting tired. This care event's been going on a while.
Yeah, good question.
There's a question here about, can you fund a policy for the future with one upfront payment? Yes, you can. There are a limited number of carriers that allow you to do that either on a pure long-term care product or a hybrid life insurance long-term care product. And there's a question here about the pros and cons of hybrid combo products versus standalone products. I'm going to go back to that slide just for a second. Now, I outlined kind of how these products work. The simple lesson in life is this one. Nothing's free. Right? If you're getting two things, you're paying for two things. And so if you're buying two things over here, it depends on how much of what you're buying, right? The reason that in the product that looks like the life insurance product with the accelerated death benefit, this is mostly life insurance because the majority of that premium is going towards the life insurance benefit. There's hundreds of these products out there, right? But it is, again, a long-term care afterthought. It's a life insurance benefit first. This one over here that attempts to minimize the life insurance means you're paying less for life insurance. You're getting more long-term care insurance, right? If you design a product as a pure long-term care benefit, you're going to get more long-term care benefit for your dollar. Maybe I'll tie also together the question about single premiums and this discussion as well, because oftentimes these products here are funded on a single premium basis. Right? And if we're going to fund something on a single premium basis, what that means is you've taken money out of your resources and you've now repositioned them. They are now in the insurance company's pot. And so we also have to ask a valid question. Is it better off for that money to sit in that pot? It's earning interest there. And internally, it's buying long-term care insurance. Right? Or are you better off to hold your own money, earn interest on your own money, and just buy a pure, efficient long-term care product? Right? It really depends on your expectations of return on your own money. So this is more a conversation, not about magic of getting your money back if you don't need it. It is more a conversation about your expectations of return on the money that you have. Great question.
Okay. Well, maybe you've answered them all. I'm not sure. While you're scanning, let me ask you a business owner question. If you own a family business and you retire, can the business continue to pay your premium for long-term care?
Yes, I think behind that question are two questions. One, can I deduct the premium at all, right? Which the answer to that question is yes, and there's a variety of ways that we can deduct these premiums. We can deduct them either as self-employed medical expenses if you have any form of self-employed income. We can deduct them as business expenses through the business. We can also, if you have a health savings account, we can use those dollars to fund long-term care on a pre-tax basis. So, the compelling nature of insurance as a leveraging tool gets a whole lot more compelling if somebody else is helping pay the premium, right? That's somebody else being Uncle Sam. So behind that question then is, if I own a business and my business funds that premium on a pre-tax basis, and I then retire, can the business still fund it? The simple answer is yes, absolutely. Section 162 of the code allows for the business to fund the premium for services previously rendered. And so a lot of times when we're internally transitioning a business from one generation to the next, the kids just keep paying the premium, right? And they can do so on a pre-tax basis.
Well, we're coming up on our hour here, so I'm going to begin the close here. So we've reached the end of our webinar time. So thank you, David, again for sharing your wisdom and insights with us today. I think it's really, really helpful. If anybody has questions, David, can you put your contact info up on the screen? If anybody has any questions or want to talk more about long-term care considerations or benefits, please reach out to David directly. And you've got his contact info. Can you see that on there? I guess I can see it. Yep. So, just to see how long-term care fits into your overall financial planning. So we have recorded the session and we'll post it to Ronald Blue Trust YouTube channel in a week or so. We will actually email you out a link when that goes live on our YouTube channel. And we'll include David's contact info as well. So we encourage you to watch it again. There may be a few things that you caught on to as David was going through the last hour or so. You might want to see how that fits in the bigger picture as well. And feel free, of course, at that time to pass it on to family members and friends who might be interested in this topic as well. So one final thing is I want to ask for your participation. We always do a brief survey at the end of every one of our webinars. And you'll see that pop up in the browser window when we terminate the session here, but also we'll email it to you tomorrow. So just do one or the other, but we sure appreciate your feedback on that. I apologize for some of the technical glitches we had. I've been unable to hear David without logging in separately from my phone. Not sure what happened there, but things break down once in a while. But anyway, your honest feedback is very valuable to us. So again, thank you for joining us today and God bless you all. Bye-bye.